Hi traders, welcome to this live wave webinar. My name is Chris Svorcik from Elite Currency, and today's session we're going to focus on counting price swings for Elliott Wave. We already have had two other webinars. Every 2 weeks we have one webinar. We discussed SWAT candles, we discussed fractals, ECS fractals, and moving averages in the very first webinar, specifically the 21 EMA zone and the 144 EMA close. And in the second webinar, specifically fractals and the SWAT candles, and specifically also fractals versus moving averages. So this is session number 3. Very excited to be here and talk about wave webinars. Waves are really, in a way, complicated, but also not complicated. It depends. And you can also use them in various ways. So I think that many traders underestimate how useful it could be, overestimate maybe how difficult it is, and if you do it in the right way, it could be very useful with not much work. But if you do it, it depends how you do it. If you use it only for trading purposes, it could be very confusing if you don't use the right tools. And the learning curve is very long and steep if you just only use price action and you only use Elliott Wave for trading. Then it could be quite difficult. But if you use the tools that I try to explain and you use Elliott Wave for as an extra, not as the main trading tool, I think it has a lot more value than we think in general. Now, all of this, what I'm going to mention in this webinar and past webinars and future webinars, is fully explained in a course from A to Z in my SWAT course, Simple Wave Analysis and Trading. It includes not only the 600-page ebook, but also, which you can buy separately if you wanted to for 25 euros, but also 22 hours of recording, 70 plus videos, all the indicators, all the strategies and systems is in that. And you can either become a member if you wanted to, just for your information, by paying the course price or by getting it through a broker sponsorship. All right, enough about that. Just wanted to tell you how you can get more of this if you wanted to. Let's move on. Not going to look at a presentation. I really want to look at charts today. I think it's always the most fun. All right. So there are a couple of ways how you can spot swings, price swings, in a methodical way. And I think that's the biggest point, actually, is to find a method that you can reasonably implement again and again that stays the same. So if you apply a very discretionary approach to identifying a wave, it's going to be one time it's going to be that, the other time it's going to be this. So it's important to have a very rules-based approach to pricings. What is one price swing? And there are a lot of ways of doing that, and I don't think there's any wrong or right way of doing that in most cases. I'm going to share a couple of what I like. Not saying that those are the only ways, but it is, in my view, one thing is very important is to find a rules-based approach to determining price swings. Because once you've determined the price swing, that's not only good for waves, it's good for fibs. It's good for understanding the context of charts, what is impulse, what is correction, and therefore chart patterns. So my SWAT course goes way more beyond Elliott Wave. It is really about a total way of understanding the charts and what to expect from price at any point. What are the probabilities of price moving up or down, or going sideways or doing nothing, right? So price swings is an integral part of understanding the charts. So as I always say in other webinars, learning how to identify price swings is really, really critical, no matter what type of trader you are. The difference between a price swing and a wave is attaching or adding a label to it. A wave 1, 2, 3, 4, 5, or wave A, B, C in Elliott wave, or WXY for that matter, right? So you're attaching to each price swing. Here's one price swing. Let me add. I'll tell you why I think it's one price swing in a second, right? That's one price swing. So a person who used price swings could still use that info. They could, for instance, they could put a fib on that price swing, right? So that gives them info about the retracement. Hit the 61.8 fib, fell down to the minus 272 target, almost reached the, basically reached the minus 61.8 target. They're just a few pips shy. So anyone can use the price swing. The Elliott waver would go beyond that and say, okay, this is one price swing. I'm not only going to put the fib there, but I think it's a wave A or it's a wave 1 or whatever. They're going to label that. So that's the difference. It's a small difference. So really, if you understand price swings, adding wave analysis and wave patterns to the mix, to your analysis, is not such a big step, in fact. But not everyone would want to do that. I understand, but it's not that big of a step. And in my view, I think almost all traders will benefit from understanding impulse and corrective price swings. Now, how can we identify price swings? There are, as I said, a lot of methods. That's what I basically want to focus on today, is how to count the price swings for Elliott wave. So how to do that, how to count the price swings, we need to start by the foundation. And the first step is identifying the price swing. So we can do that by, first of all, basically looking at impulse and correction. So impulse and correction is fast and slow price movement. So this is all fast price movement to the downside between the red lines. And then we see price moving fast to the upside, right? So this could easily be one swing down. Although there was a little bit of a pause in here, as you can see, right there. I'll make it a different color. Green, right? So there was impulse, pause, and impulse. So it depends on what degree of chart you're looking at. On every time frame, you will see one swing. But if you zoom into a lower time frame, let's take a look at the hourly chart, you will see more swings. On the hourly chart, it's clearly 3 swings, right? Impulse, correction, sideways, and an impulse. So on the hourly chart, it's clearly 3 swings. On a 4-hour chart, one could argue it's 1 swing, although you see a small mini swing in between. Whereas on a daily chart, you wouldn't see that at all, probably. And you wouldn't even see a swing. You would see maybe 1 swing indeed here, right? That's 1 swing. So you wouldn't see that pause. So all swings are kind of like Lego pieces. They connect and to build bigger swings, right? So you have a couple of swings building 1 swing and a couple of swings building another swing on different time frames. And all these patterns repeat because the chart is fractal of nature. So that's one thing. Swings can be found on any time frames, and swings are going to be fitting with each other to build bigger swings. The swings can be impulsive or corrective. Impulsive is quick price action. So how do you know it's impulsive? There are 3 characteristics of impulsive price swing. Basically, if it's a bearish impulse, of course, impulse can be up or down, bearish or bullish. In this case, it's bearish. That means that the majority of the candles are going to be bearish. So about 2 out of 3 typically. Well, you can see that out of this group of about 11 candles, 8 are bearish. So that is 72%. So that qualifies. The bears are going to control the candles mostly. That means the candle closes are going to be near the low in this case, in most cases. And the bearish candles are typically going to be, the impulsive candles are typically going to be larger than the corrective candles. So you see the bullish candles are typically smaller, whereas the bearish candles, not all candles have to be large, but a couple of at least of them are larger. So those are 3 characteristics. Majority of the candles are going to be in that direction, in this case bearish. Most candle closes are going to be near the low, and there's going to be The third one was, now I forgot my train of thought. Majority is low near the, size, the candle size. Some of these bearish candles are going to be larger. So for bullish momentum, majority of the candles, for instance, here to the upside, majority of the candles are up. There are going to be a couple of bigger bullish candles indeed, and most of these bullish candles are going to have closes near the high. Yes. So what is a correction? What is a corrective swing? Indecisive candles, smaller candles, basically. So indecisive means more dojis, more closes in the middle of the candle. Indecisive candles means, basically, that's an indecisive candle, of course. Smaller candles in general, like these, they don't have the big size typically. And a mixture of bull and bears. So that's going to be corrective. And this is a very, very important concept, not only for Elliott wave, but just for analyzing the charts. It gives so much value because with impulse and correction, you not only know where to place the fib, but you also know how to understand flow and chart patterns, and if you want, Elliott wave patterns as well as extra. Because typically, there's the momentum, you have a momentum, a pattern like a bull flag, and typically the momentum continues in the direction of the momentum before that. For instance, that's a continuation chart pattern. A momentum flag and momentum confirm that. So by using momentum and correction, you can understand price swings. It's an important thing. It's not, you can definitely use other concepts to understand price swings, and I'll explain more of them now. But this is the groundwork, let's say. This is the basic stuff you need to know. So this is a huge swing up, huge momentum, right? And here we had a big correction. Price going sideways, as you can see. Momentum, correction, and the momentum again. So using those rules of the momentum and correction would help identify that. What other tools are useful for helping identify one swing? Well, there's going to be quite a long list. I hope I'm not going to forget anything. I could always have a follow-up webinar on this if I do forget anything. But moving averages is one of them. So price crossing the moving average and then recrossing again. In this case, the 21 EMA zone that I use, price crossed above it here and didn't cross or close below it. There was a cross here, but not a close. The close below here. So all the time, price was riding beautifully and very smoothly this 21 EMA. Again, pointing back to our first webinar about 21 EMA and 144 EMA, how important that is. Identifying the price swing is one of them. This is just one smooth up, one price swing on the 21 EMA. Then we have, let's continue with that. Then you have a price swing down, and then from the top, of course, though, then a price swing up, and then again a price swing down. So it's a three-wave down, basically, right? ABC maybe, for instance, for those that are already a bit more advanced in the Elliott wave theory. So that's how you can see how price is responding. Now, eventually price might be crisscrossing, above and below the 20 EMA a little bit more, but you can still use the same principle. This is a price move up, price move down, up, down. Here nothing because it didn't close, so this would be 1, 2, 3, 4. Only here it's 5. Here we barely had a close. I would say it's not. This was just one swing up. And then again a retracement. So it's like about one swing, a second swing, a third swing here, fourth swing, a fifth swing here actually. Yes, this was all one swing from here to here. Let me show you. I would consider that based on the moving averages one swing. So obviously this is a swing, this is a swing, this is a swing, this is a swing. So it's 1, 2, and 1, 2 swing here. Then again 1, 2, and then we have one push up all the time up until we get into this spot. So 21 EMA very useful, I think, for trying to spot one swing, specifically when you get in a momentum like this. When you get in a range, it can get a little bit unuseful, to be honest. But when there's a strong momentum, then it's a very useful tool. The 144 EMA is very useful. Let's see. Joe, sorry about that. I'll try to be slower. I think it's maybe I'm just too fast with the cursor. 144 EMA is very useful as well for identifying price swings. Well, the 144 EMA is more important for identifying wave patterns, to be very precise. So I will leave that for another webinar. But generally, just a quick tip there. Waves 2 and 4 typically end at the 144 EMA. I won't dive into that here because it's a bit it's going a bit further than I wanted to. I want to explain other things first. But yeah, the 144 EMA is a very long two moving average, and price breaking or bouncing at that also says something about the waves. So, and the waves specifically, not maybe much about the price swings, but more about the waves. So, if price is breaking, reversing against the 144 EMA, that could indicate the bigger trend reversal. Whereas if it's a bouncing, trend continuation in general. Regarding price swings, other things besides the 21 EMA zone that are useful is the oscillators, the ecs.MACD, and the awesome oscillator. So let's take a look at an example. So very, very mathematical way of looking at it is by using these oscillators, because this is one push up. How do you know? Because the AO bars cross the zero line here and recross the zero line here. So let's take a look at those AO bars right here is the cross, and here's the recross. So you might be wondering, why is this not the price swing? Because we always look at the low and high of that push up. That's why the price swing itself is this. This is the low before the cross, and this is the high before the cross. That's the main price swing. Of course, with the AO, we would only find out at this point about that. So it's a little bit slower. With the 21 EMA, we would find out a little bit sooner in this case with this candle. So sometimes, of course, we're not 100% sure when the price swing. This is a bit slower example of that, to be honest. Sometimes it's not that slow. For instance, let's take a look at a better example. Here, it's a bit faster. All right. So sometimes we'll find the oscillator switch to be a bit slower, but not always, as you can see. And let's take a look at another example. Right here, for instance, as well. So as basically the oscillator staying on one side of the middle line, that indicates one price swing. And we can use the ecs.MACD for the same idea or same approach, using the two-line MACD for finding those price swings. Okay, so this here was one price swing. Excuse me. Cross the zero line here and recross the zero line somewhere in here. Okay, so when this bar closed, we know that this price swing is finished. That is one price swing. That is one push lower, and we're now in a different price swing. And we know that this price swing is a leg on its own. Okay, when price is here, we can see it's below the 20 EMA, and we see also one of the important rules is I will talk about that in actually the next step. So I don't want to spoil that. So let's wait for that. But 20 EMA, you see prices below the 20 EMA. You see also fractals below the 20 EMA. All of that indicates that this is an ongoing bearish impulse, bearish swing. And when price starts to break above the 20 EMA, and when the oscillator bars start to push above the zero line, we know that this bearish swing is over. It's finished. Now, how do we know that? So we can see, we have some methods to identify when a price swing is over after the fact, but some of these times, as you can see, it's a bit slow. Is there any other way to do it faster? Yes, there is. That's by looking at candle lows, or candle highs for bullish momentum. When there's no candle low confirming the new continuation of the trend, then the swing is in danger of being completed and being over. So here we have a candle low, candle low, candle low, no candle low, no, no, yes, no, yes, no, yes. Yes, yes, no, yes, right? So not all candles have a low, but many do. So that's important. And as soon as we have a lower low, that price swing is confirmed, that it's continuing. But as soon as we don't have a lower low, there's a chance that that might be the end of the price swing. The main difference is about 6 candles. When 6 candles do not break the low for a lower low, that is a faster way sometimes of identifying the end of a price swing. So here, unless the 6th one is bearish, then is aligned with the swing. In this case, bearish candle is aligned with the bearish swing. Then I wait the 7th candle. So 2, 3, 4, 5, 6. I wait for the 7th candle. That's this one. It's bullish. That's the end of the price swing. Already on this candle, I know that this swing is over in that case. So that's a very useful rule. Let's take a look at let me go back 1, 2, 3, just to find something random. And this could be applied almost everywhere. Now, sometimes this 6th candle rule is also slow. This is the 6th candle here. Let's see, 2, 4, 5. This is the 6th candle. So it's not always earlier necessarily, but it can be. And it's a good thing to be to have as in your kind of toolbox. Sometimes 6 candles doesn't mean the end of the uptrend, though. Just because 6 candles didn't break a high doesn't mean that the uptrend cannot continue. This is a wonderful example of that. 2, 4. Here is 6th candle, but after 13 candles, it still goes, or I don't know, 15 candles, 14, 15 candles, still goes up. So just because there's 6 candles not breaking for high doesn't mean the uptrend is over. It just means that that price swing is over. And if they're corrective candles like they are here, it could just mean a pattern, a chart pattern, a bull flag. And if a bull flag emerges, then it means that there's a high chance of an uptrend continuation, and then the next price swing will still move up. But it's a separate price swing. It's a new price swing. This is a new price swing that's not connected to this one anymore on this time frame. This is one swing up. From all the way from here, this is one swing up, and this is a different swing already. This is a corrective swing, and then we have another swing up. Whereas this swing from here to here is one swing because price is 21 above the 20-way. The awesome oscillator stays above it, and then we have the confirmation of impulse and the confirmation of time pattern. Now, sometimes you're going to see some differences between one definition of price swing and the other. According to the awesome oscillator, this is actually all one swing up, all the way up to here, actually. According to our time pattern rules, this is one swing, this is a second, and this is a third swing. So there's a bit different information about that. According to the 21 EMA zone, this is all one swing up, all the way to the top. All right, so you'll sometimes get different swings depending on different methods, and that's okay. It's that's logical if you're using so many different, potentially so many different things. So price patterns typically continue after 13 candles or more. So between candle number 6 and number 13, after the high. Is a phase where breakout is risky. And once you get candle number 13 or 14, like this case, a continuation is more likely again. Although this continuation was very small, by the way. All right, so here you can see, let's take a look at one more example then. All right, here, 2, 3, 4, 5, 6 candles, not breaking this high, reversal in this case. 2, 4, 6 candles, not breaking this low, just a retracement for more downtrend in this case, just a retracement. Here, 2, 4, 6 candles, not breaking this low, in this case, reversal maybe, or at least in any case, a large retracement. So time patterns very useful as well. Besides moving averages and the oscillators and the impulse and correction concepts we discussed. Other important thing, HMA could be useful too. It's a bit faster price swing, but it works pretty well. As you can see, look at the angle. Pink HMA down, blue HMA up, pink HMA down, blue HMA up, pink HMA down. Here's a little bit of blue, but otherwise pretty much down. So yeah, it's a faster one, up, down, up, indicating 5 waves. And again, down, up, down, basically 3 waves down. So this, is quite a useful one, I think, because it's very fast, intuitive, and does its job also pretty well, I think. Right? The only thing is you're going to have some price swings, some smaller price swings like this, that really are not really price swings in my view on this time frame. This is just sideways. They're not really price swings. They're just pauses within this full downside. So you might get slightly more swings that are not really relevant here. For instance, those are not really price swings. That's the only thing. Maybe as a disadvantage. Another thing, if you are a SWAT member, is SWAT candles. So I'm not going to dive into this that much because free members don't have, people who are not SWAT members cannot use this. So I don't want to bore people with something they cannot use. But very quickly, SWAT candles are blue, gray, red. So when the blue candle starts, that's just one swing to the top. When the red candle starts, that's one swing to the bottom. So it's sometimes obviously a red candle swing, for instance, like this could be a retracement, and you can see that because of the moving averages. So using a combination of moving averages with the SWAT candles can give you a lot of info about what is a potentially big swing or what is a retracement swing. All right. So anyhow, I'm going to move on. I don't want to bore people with, but if you're interested in SWAT candles, though, check out my SWAT course, basically. All right. Another thing you can use is Heiken Ashi candles, by the way. And they give you, in a certain way, more or less quite similar info as my SWAT candles. Sorry. Let's see if I can find that. I don't know if I have it on this chart. No, that's not the one I'm looking for. This is Heiken Ashi candles. Gives pretty good, dark red or light green here, indicating full trend. Obviously, gray or lighter versions of those colors, like red, those are indicating retracements. So that is a useful tool. For identifying price swings. And I'm thinking if I missed anything, maybe I did. Yeah, there's also this, of course, this is not something I use, but certainly is, something that you can think about using. Two is, I'm not sure if I see it here. I don't know, the Zigzag or ECS price action indicator. If you have that indicator, it draws a line from tops to bottom, basically. All right, and depending on the setting, those swings will be shorter or longer. Okay, so that's of course also a good one. Now I might have forgotten, I didn't prepare necessarily a list, so if I forgot something very obviously, I apologize. Let me know through through our email, and I definitely will add that in the next webinar. Otherwise, yeah. So how do you count those price swings for Elliott wave? Now, this is not something I actually spend more time on price swings than I counted on actually. So this is maybe too big of a topic to really continue right away today. Maybe that's a good one for next time, 2 weeks from now. But basically, as soon as you've identified one price swing, and then I'll just give you the basics here, then you need to understand if it's impulse or correction, right? So if it's impulsive, then it could be a wave 1, a 3, or a 5, or a wave A or C. Where if it's corrective, it could be a wave 2, 4, B, or part of a triangle or a complex correction. So that, of course, helps you identify part of the swings. So understanding what is the price swing is important for counting the waves. That's step 1. Then understanding what the character is of that price swing, so you know what waves they are or not. And then step 3 is trying to build the story of the waves. So if, for instance, you saw a strong uptrend, and then you saw a correction and an uptrend continuation, and then you see a strong fall to the downside, and you might consider that, the fact that there are 5 waves completed to the upside, then that strong fall could be a wave A, and the upside could be a wave B, and the downside could be a wave C. So obviously the connecting the swings to help identify what the next swing could be is a part of that. So identifying one price swing through the methods I mentioned, then understanding what the characters of that price swing, and then understanding the characters of the other price swings, and then labeling those price swings. That's very quickly the art of the Elliott wave topic, or the price swings and combination of the wave patterns. But we're going to dive into that more on 2 weeks from now, I guess. That's then the 19th of October. And go through all the details of using price swings for Elliott wave counting. Okay. And go through some examples and how to do that live, and also identify when the analysis is correct and when the analysis is incorrect. Okay. Using Wiz is also a good tool, by the way, besides those methods that I mentioned, because of the fact that if price is moving very strongly away from the 144 EMA, then it's likely a wave 3, and it will likely move to high Wiz levels. Okay, and whereas if it then retraces to 144 EMA, it's typically a wave 2 and 4, as I already mentioned at the beginning of this webinar. So as you can see here, this is probably wave 1. Here, wave 1, 2, wave 3, 4, up for wave 5. But within wave 5, you probably have again a wave 1, 2, 3, 4, 5. So there's a 5 wave within wave 5, and then you get a bigger ABC correction. And yeah, we have to work with the past to identify, of course, the potential current swing and next price swing. Okay. So that's it for today. We'll be back 2 weeks from now, and we'll use all our price swing knowledge to talk about how to label those waves in detail. See you over 2 weeks, and of course, maybe in the other webinars. And by the way, if you like our work, or if you don't, if you're interested in leaving a review about our work, we'd certainly appreciate your review on Trustpilot. Let us know what you think about us. We only have 5 reviews there, so we would like to get more feedback from our followers and non-followers. Anyone who wants to, of course, feel free to do that. Thank you, and wish you all great trading. Cheers. Bye-bye.